So, how can we identify turning points in the market using Fibonacci and the Fibonacci tool? Now, before we can talk about the Fibonacci retracement tool, we have to understand where these numbers come from that we're using on this tool, because you can't just blindly accept, I'm going to drop this tool on my chart, it's going to tell me everything, unless you understand what each one of those lines represent. You're just shooting at ducks. So you have to understand how we get from the Fibonacci sequence to the Fibonacci ratio to the Fibonacci tool. It's not very complicated. And after tonight, you'll never have to talk about the mathematics again. But you need to have a good, solid understanding. So Fibonacci retracements are ratios used to identify potential reversal levels. These ratios are found in the Fibonacci sequence. The most popular Fibonacci retracements are 61.8% and 38.2. Now note that the 38.2 is often rounded out to 38%, and the 61.8 is sometimes rounded out to 62. So after an advance or a decline, chartists apply Fibonacci ratios to define the retracement level and forecast the extent of the correction or the pullback. Now, I know we're talking about a concept here. I'll show it to you on the charts in a minute, and I even have a very graphic presentation to share with you that'll show you this. But before we get on to that, let's get some of the basics knocked out of the way. Fibonacci retracements can also be applied after a decline to forecast the length of the counter trend bounce. These retracements can be combined with other indicators and price patterns to create an overall strategy. So in other words, when prices moved up from this level and then downturned and started moving down, we can apply the Fibonacci tool, and what it'll do is tell us where we can expect each of these corrections as this price moves down in the opposite direction of its previous move. That sounds great, doesn't it? Sounds like it makes trading really easy, doesn't it? Well, it helps us, but if you notice, we talked about 38.2 and 61.8, and we talked about 38.2 being rounded off to 38 and 61.8 being rounded off to 62. Well, if you're trading in pips and trading leverage with euros, and you're trading in a couple pips, and we've rounded things out, well, guess what? If you were to use that line and tried to make a trade based on that line alone, you know you're automatically wrong because you're just using an average or an estimate or approximation. So Fibonacci retracement levels are not carved in stone. So think of them as alerts. Think of them as zones or areas. Now, tonight's class is not designed to delve too deep into the mathematical properties behind the Fibonacci sequence and the golden ratio. There are plenty of other sources for that detail, and I know most of you don't want to know anything about it. Okay. You don't want to know the math. Okay. It's a lot of big numbers calculated in very complex ways. But you do have to understand how we get from the beginning numbers over to the sequence and then to the ratio. So Fibonacci was developed in the 11th century. Way before there was financial markets, way before there was online trading, way before Forex ever existed. So it wasn't developed for financial traders. It's been adapted for financial traders, but it's found throughout the universe. Fibonacci sequence and Fibonacci numbers are everywhere. So we start off, and if I remember correctly from my school days, I think it was done by watching rabbits multiply. Somebody's checked me on that a couple months ago, and I don't remember the outcome, but I think that's exactly where it came from. So if we start out with 0, means nothing, and then we were to get 1 rabbit, we'd have 1. If we would add 1 more rabbit, we'd get 1 rabbit plus 1 rabbit, and we would have 2. Now, what we have is 0 plus 1 gives us 1. 1 plus 1 gives us 2. 1 plus 2 gives us 3. 2 plus 3 gives us 5. 3 plus 5 gives us 8. So in other words, you take the 2 previous numbers and add them together to come up with the current number. So in other words, we take 8 added to 13, the next number in the Fibonacci sequence will be 21. And it's always the same numbers. You start out with 0, and Fibonacci sequence runs out into eternity, but it's always these same numbers. There's never a difference. 0, 1, 1 plus 1 is 1, or 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, and so on and so on and so forth. So this gives us the Fibonacci sequence. Now the sequence extends into infinity and contains many unique mathematical properties. In fact, we can find it in the ratio of your nose to your ears to your mouth. We can find it in the ratio, or we can find it in the sequence of the shells on a snail. We can find it in all Greek architecture. We can find it in the placement of the stars in the universe. This sequence comes up over and over and over. And it's the basis for so many things that nobody knows where it came from. Nobody knows why so much around the world is based on this. But the Greeks used it for all their architecture. It's said that the more beautiful a woman is the closer she is to the Fibonacci sequence or ratio with the placement of her eyes, her nose, and her mouth. Now, how do we get from the sequence over to the ratio, over to the financial markets? So we've got the numbers. 1 plus 2 equals 3, 2 plus 3 equals 5, 5 plus 8 equals 13, 8 plus 13 equals 21, and go on. Now, if we were to take that sequence and do some funny little things with those numbers, guess what? We would find that that same numeric value was applied over and over and over throughout that sequence. So if we were to take this part of the sequence right here and take the current number, we took 8 plus 13 and gave us 21. See, if we were to take this 21 and divide it by 13, it would give us 1.615. If we were to go farther out in the sequence and take 13 plus 21, and that gives us 34, and we were to divide that 34 by 21, it's going to give us 1.619. If we go all the way out to the 55 and the 34, it's going to give us 1.6176. All the way out to the 89, and if we went all the way out to eternity, it's always going to give us 1.618. The approximation nears 1.618 as the number increases, and it always stays in this approximation. Now, if we were to go one step farther and take the same numbers, but instead of taking the 21 and divide it by 13, we're to flip it on its head and take 13 and divide it by 21. So we would take the current number as the division and divide it the previous number. So 13 divided by 21 will equal 0.619. We would take the next to 2134, give us 6176. 34 plus 50 give us 618. And the approximation is 0.618. And this is the basis of the value of the 61.8% retracement. Now, if we were to go one step farther, so instead of going to the 8 and 13, we had the 8 and 13 and then the 21 and the 13, which gave us the 34. And we were to go 34 and go back 2 digits, that would give us 0.382. We went to 21 and 55, it would give us 3818. It's always going to be an approximation of 38.2, which gives us the 38.2 retracement. Funny part is we take the 38.2 retracement and add it to the 61.8 retracement. Guess what we get? 100% all the time. So if we wanted to continue farther and farther on with the Fibonacci sequence, the Fibonacci ratio, we could then move it 3 digits apart. So in other words, we would take this gives us 34, and then 21 and 34 give us 55. And we were to go 2 digits over and take the 13 divided by the 55, that would give us 23.6, and just so on and so forth. So that gives us the 0.236 approximation, and this is the basis of the 23.6 retracement on the Fibonacci tool. Now the main retracement numbers are 23.6, 38.2, 61.8. And guess what? For the hell of it, we put in the middle 50%. Now, 50% has absolutely nothing to do with Fibonacci. So we started off on our chart over here, our previous, all that multiplication, with the 1.618. This is referred to as the golden ratio, the golden mean, or also called phi. The inverse of 1.618 is 0.618. 0.618 is 61.8% in the Fibonacci sequence for the Fibonacci tool. So as I mentioned, these ratios can be found throughout nature. Architecture, art. The proportion of the 0.618 to 1 is a mathematical basis for the shape of playing cards, for the Parthenon, for sunflowers, snail shells. The Greeks based most of their art and architecture on this proportion, and is called the golden mean. Well, when we take it over to the financial markets, we have the 38.2 retracement and the 61.8. These are the primary retracements with 50% put in the center. Now, the 50% level has nothing to do, as I mentioned, with Fibonacci. It comes from Dow theory. It didn't even come around to the 1900s when Charles Dow, who was the father of technical analysis, realized that when price moved up, it tended to retrace to half of its prior move. And because 50% fits in with the move or the retracement levels, not the Fibonacci, but fits in with the retracement levels, it's incorporated in the Fibonacci tool because it is an important retracement level. So what are these retracements? It says when an asset is pushed up a certain amount, it will retrace a percentage of that move before continuing on its way. So it might have a shallow move or retracement to 38.2. If it doesn't, it would come down to the 50% retracement level, or it might come down as far as the 61.8. It is based on the length of the prior move. So it said that price could retrace 61.8% of the price. So if this had moved from 0 to 100, price might retrace all the way down 61.8% or down to $38. And then we'll bounce back up to continue on its way. We expect or we hope that price is going to bounce down to 38 too. But if it doesn't, it might come down to the 50% level. But it said you shouldn't be panicking until it gets close to the 61.8 level. Okay. It's where do you decide that price is going through a retracement and a recovery, or where do you decide the trend has ended and is about to reverse? So let me share a little presentation I prepared for you. Oh, by the way, before we get on with the presentation, I forgot to mention, if you look on your screen, you see it where it's labeled handouts. And you see I put together 3 handouts for you. One is entitled the Fibonacci Retracement Guide. That will give you all the details, step-by-step examples and processes of understanding how to use the Fibonacci tool. So you don't have to write down and remember everything we came in class. And it's even more precise than what we're going over in class. I've also given you the Introduction to Technical Analysis ebook from investing.com, which goes into all of the different technical analysis tools and will teach you all about retracements as well as Fibonacci retracement tool. And then I've given you a technical analysis, a technical indicators guide from investing.com that will go over all the primary technical indicators that you can use on your charts that you should combine with Fibonacci to make smart trading decisions. So let's pop up this presentation. And first we're going to talk about what Fibonacci's are and what this tool does or how you can use the tool. And then we're going to go over to some real charts. And I'll show you exactly how to do it step by step on the charts.
Mathematical equations and strategies out there that try to make sense of a market that is largely speculative. However, it is widely accepted among traders that rely on technical analysis that most major moves will retrace around the Fibonacci levels and more specifically around the 50% level of the move. So in an uptrend, a price will retrace down a certain percentage of the move before continuing its long upward movement. Likewise, in a downward trend, the price will move up a certain percentage before continuing its long-term downward movement. If the price moves beyond the 50% level, it might be a signal a trend reversal is about to happen, and it may be an opportune moment for switching the direction of your next trade. In this tutorial, we will simply refer to the Fibonacci retracement tool and how to use it. We will be explaining the mathematics and more on Fibonacci in following video tutorials. So traders use these Fibonacci levels as efficient entries in the direction of the trend because many traders watch these same levels and place buy, sell, or stop orders based on them. They are quite accurate and become a self-fulfilling prophecy. So how should you enter in an uptrend? You can use the Fibonacci retracement levels for an entry into the market. For an entry in an uptrend, you should look to see whether the price finds support at these levels. Then we suggest you wait for confirmation that the price will move back into the original upward movement and then enter. As with any technical indicator, it is better to seek additional indications to support your initial analysis so that you don't base your trade solely on Fibonacci retracements. Look for clear signals to buy or sell. For instance, wait for a candlestick to close in the desired direction to give you more confirmation on whether you should place an order. If it does form, you can place a market order at this point as you have solid reasons to believe that this level could hold. How to enter in a downtrend. Likewise, for a downward trend, you can place your entry after the price has found resistance at one of the Fibonacci levels. After you wait for confirmation that the price will move back into the original downward trend, you can place your entry order. So how to place your exit. Now that you have decided on your entry, you need to determine your exit strategy. Your exit strategy is comprised of 2 steps. First one is deciding where to place your stop loss, and the second is where to place your target profit. Let's look at the same graph that we had for our upward trend. Here we suggest you place your stop loss just below the retracement level. In a downward trend, we suggest you place your stop loss just above the retracement level. Where should you take profit? And now for the best part, your target profit. If we use Fibonacci retracement levels to forecast entries into the market, we can use Fibonacci extensions as reasonable profit targets. Fibonacci extensions make good potential take-profit levels for trades in the direction of the trend. Similar to the retracement levels, the key Fibonacci extension levels are 38.2%, 50%, 61.8%, as well as 100, 138.2% and 161.8% extension levels. The Fibonacci extensions correspond to retracement levels, making it all very simple. If you enter at 50 or 61.8%, a good take profit is the corresponding extension level at 161.8%. Let's go to the Trading 212 Pro platform to demonstrate how to use the Fibonacci retracement tool. Here we have opened the chart for the German index DAX in a candlestick mode at a 1-hour time interval. The price's movement is easily recognizable. In the Trading 212 platform, on the side you have a Fibonacci icon. When you click it, you choose retracements. Then you click right where the trend begins and drag until you reach the end of the movement. Where the move started, you'll see a 100 displayed on the side, and where it ends, a 0. When you have plotted this line, the Fibonacci tool automatically places the retracement levels based on the Fibonacci number sequence. In our case here, you see a retracement at 38.2%, and we would enter at this level. We would then place our stop below the entry level. You could place it either below the 50% or the 61.8% level. We will take the first Fibonacci extension level at 61.8% as a reasonable target profit. To summarize, a retracement is a short-term price correction during an overall long-term upward or downward trend. The benefit to trading retracements is that they provide an opportunity to profit by entering a trade in the original direction of the trend at a better price. The basis of the trading strategy is to buy pullbacks in an uptrend and sell rallies in a downtrend. A good way of identifying them is to use Fibonacci retracements. To set your take profit, you can use the Fibonacci extensions as reasonable profit targets. As always, we recommend you use stop losses. They can be placed above or below the last retracement level. What to watch out for?
Okay, now I just want to note for you guys that we're going to be looking at a couple presentations tonight. These presentations in the recorded version are not inserted. So if you want to see these presentations on their own, you can go to my YouTube channel and just go to YouTube and then type in Forex and you want to use the ampersand for and CFD education. That's not a search, it's the name of the channel. Once you get to that channel, just look for the playlist for Fibonacci and you can see these presentations. But I just want you to know, because a lot of people send me back emails saying, oh, we didn't get any volume or any sound. We just saw a white screen for those few minutes. And that's why, because the webinar recording doesn't pick those up. So just be aware. Now, let's talk about, because a lot of people get confused about how to put these on our charts. So in order to find the Fibonacci retracement levels, you have to find the recent significant swing high and swing low. Remember the word significant. Okay, it's not necessarily the lowest point it traded at. It is the most significant point low that it traded at. Because lots of times in trading you have some kind of craziness that sends a price way down low and it just recovers 2 seconds later and ignores it. So you're not going to go back 3 hours before to just that low if it wasn't a significant low. Then for downtrends, you click on the swing high and drag the cursor to the most recent swing low. For uptrends, you do the exact opposite. So let's go over to a chart I have set up. Hold on a second. Let me pop up the chart here. Okay, So we're looking at the euro US dollar in a 2-hour chart. So we can see that the asset, the euro, has finished a significant uptrend and has moved to a downtrend. We're not concerned drawing the tool on the current downtrend. We have to draw it on the finished trend. So we would locate the significant swing low, and we would find that right here. See, because it's significant because that's when the asset turned and started moving to an uptrend. We'd also locate the swing high. Here we have a very significant swing high because we have two identical candlestick highs and the price moved down. Once we do that, then we go over to our toolbar and we locate our Fibonacci retracement tool. Click on it, and then we take it and we go to the swing low and pull it up to this. Oh, hold on. For some reason it locked on my screen. Something's going crazy. Hold on a second. Oh, that's why that's turned on 23.6, 38.2, 50%. And we want to turn on 0 and now we can set the Fibonacci tool to any color we want. So we use a red we'll use gold. For a very important number, we'll use we'll leave it blue. For the 38.2, for the 50, for the 61.8, and then we'll go to gold for the 76. And zero. 23.6, 38. Well, let's take the 23.6 off. We don't need it for class right now. So now what we have is so now we have our Fibonacci tool drawn on our charts. And so this is 100%. So the move started here with a 0. It's up here at 100%. We have here at 38.2, here at 50% retracement, here at 61.8. Actually, let's go back in. I'm just trying to labels to the right. So you can see on the right here, the level and the price. So that's 0, 50, 61.8. Okay. Now, we've noticed that, look at that, price came down off of its high. Where did it retrace to? Look at how significant this 38.2 was. Price touched this in its first now, retraced off, bounced off of it, came back up, came back down. Now it just sailed right through there, sailed right through the 50%, but the low wasn't able to reach that 61.8, but it moved right back up to that 50%, came back down right to the 61.8, bounced off of it. Now look at how it's congested right on that 50% level. Came back off of there and came right back down to the 61.8. So all of that told us a very good story about price movement. Now remember, I told you these were alert zones because we're using 61.8, but remember 61.8 is simply an approximation of 0.618274. So it's not an exact number. Now you can combine these with other things like support and resistance from eyeballing, pivot points, and build yourself very important support and resistance levels. So you notice it's not so difficult to put it on the charts. You simply locate the swing low, the significant swing low, the significant swing high, take your tool, and then grab it at the significant swing low, pull it up to the swing high, and there you have it. Very, very easy. Now, you've got it on your charts. What are you going to do with it now that you got it there? Okay. You can do lots of stuff in the settings like you saw me do. We can turn off and on because you can put the extension levels on there all the way up like they talked about in the presentation. That'll show you as price moves upward. You can decide what you want to see. It'll put a trend line on for you. Okay. You decide. You can also decide how thick you want the levels, how broad you want them. You customize it to however you want to set it up. Okay. So now that we have it on our charts, let's go back and start learning about how we can use this in our trading. And if we're coming off of a downtrend, you just draw it the exact opposite way. You pull it from the swing high down to the swing low. So in order to apply Fibonacci levels to your charts, you'll need to identify the swing high and the swing low. A swing high can be described as a candlestick with at least two lower highs on both sides, right and left, or a swing low is a candlestick with at least two higher lows on both sides. When using the Fibonacci tool, the probability of trading success could increase when used with other support and resistance levels, trend lines, candlestick patterns for spotting entry and stop loss points. So remember, these are alert zones. Retracement levels alert traders or investors of a potential trend reversal, resistance area and support area. Retracements are based on the prior move. A bounce is expected to retrace a portion of its prior decline, while a correction is expected to retrace a portion of the prior advance. Once a pullback starts, chartists can identify specific Fibonacci retracement levels from monitoring. Remember, I said monitoring, alert, okay? So they're not exact numbers, so you don't want to use them for entry and exit points. You want to use those for general point. Stop loss and take profits can, because you don't put a stop loss to an exact calculation. You want a level, or you want to identify a candlestick low or high. You want your entry, your exit levels, a potential area you want to exit. So keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for potential reversals. It's at this point that traders should employ other aspects of technical analysis to identify or confirm reversals. These may include candlesticks, price patterns, momentum oscillators, and moving averages. So I've got a presentation prepared for you about how to use the Fibonacci retracement tool in the real world. So let's take a look at this, and then we'll move on a little bit. And make sure you download those handouts I've got for you so that you can have those and move them around, because they're only available in the live class. And remember what I told you about the presentations and finding those in YouTube under, go to Forex and CFD education. But and is with an ampersand, you know, a little like plus sign.
Take a look at Fibonacci in the real world. What we're looking at is gold. So I'm going to do a couple of historical examples to show how it might have worked, and then a current example on gold. So let's pretend it's the end of February, so we're here. We've watched gold go from these December lows around about $1,120 an ounce, up as high as here, up as high as sort of 1260 area recently. And it starts to come off. So we think, right, I'm going to use my Fibonacci retracements to try and figure out where the price of gold might stop sliding and bounce and continue this trend. So let's put the retracements on. So we pick them up from here. We start at the beginning of the move. So I click down there and then drag it all the way up to the high. And it puts the retracements on for me. Let me just adjust this one down here. There we go, that's better. Like a lot of software, it does include some additional Fibonacci levels, but the main ones I'm worried about, let me just make this a bit clearer. I'll right click, change the color, make the lines a bit thicker. Here we go. So what I'm looking at is the 23.6, the 38.2, the 50, and the 61.8. So if the Fibonacci is going to work, the market's gone up, and then we're looking to see if these levels, the 23.6, the 38.2, the 50, and the 61.8, do they support the market? Let's just walk through and see what happens next. So these are daily candles, don't forget. So the market's selling off. So we're on the 23.6 level now. That's broken, it's gone through that. So the next one to watch for support is the 38.2 at 1209. That's gone again. We can see it breaking through. And the next level we're looking at is 50%. So the market's gone from here up to there. And now if it gets to this level, it's dropped back 50%. That's our next Fibonacci level. So let's just push it forward. And actually, it looks like it's working. So the market went from X to Y, dropped back 50%, and the market has recovered. Let's have a look at the next rise. What happened next after this? The market did push higher up to here, just back up near that old high, and started coming off again. So again, as usual, let's just adjust our lines. So we'll pick it off that high there. And again, we're just trying to see now what happens. Does the market hold on these old levels? I think it's pushed just a little bit higher. So let's just nudge it up to that high up there. There we go. And it started coming off. So our 23.6% level is at 12.54 an ounce on gold. Then we've got 12.28.5. That's our 38% retracement. And then the 50% is there at 12.08. And then the 61.8% is there at 11.87. So let's just walk through and see what happens next. The market's sliding. So it's taking out that 23.6% level. So 38.2, that's the next level to watch. It's taken that out. But so far it's holding, and once again the 50% retracement level has worked. So it took out the first two Fibonacci levels, but the market did move higher again. Okay, so now this is an up-to-date chart for gold up until the end of last week. So the market had pushed higher beginning of June, sold off. Let's put our Fibonacci levels on. Let's take them again. Let's take them again from the start, from down here. So from those lows in December up to the most recent high, beginning of June. Again, I'll right-click, make this a different color so we can see it. There we go. So the market slid off, has slid below 23.6. At the moment, it is holding above that 38.2% retracement at 12.30-ish level. And if that level breaks, the 50% one to watch out for is 12.10. So there might be a couple of levels.
So if you've been paying attention in class, you'd also know by now that you can combine the Fibonacci tool with support and resistance levels and trend lines to create a simple but super awesome trading strategy. These three pieces of information that are very simple to access and put on your charts will at least tell you whether you should be buying or selling an asset. So basically, we're looking for something that's going to filter out all the other garbage, all the other assets, and only give us high probability trades that will have high probability of success. And these three simple tools, a Fibonacci retracement tool with support and resistance level and a trend line, will tell you or filter down and give you high probability successful trades. Now, you need to then determine your entry points, your exit points, your risk management. But the first thing you have to achieve is which asset you're going to trade, which direction you're going to trade, or even if you're going to trade it. And then you've got the opportunity, and then you have to define the opportunity. So when combining the Fibonacci retracement tool with candlestick patterns, we are actually looking for exhaustive candles. If you can tell when buying or selling pressure exhausted, it can give you a clue of when price may continue trending. Volume is another great add-on for these. Okay. Volume added to the Fibonacci's will let you know exactly what traders are doing as price approaches one of the important retracement levels. So if you combine volume, support and resistance, trend lines, and then simple candlestick patterns, you have a super duper trading system. So Fibonacci's will help you find entry points, exit points, and help you define where to put your stop loss. So all this in one great simple little tool. Now you just have to decide your risk management and what you're going to do or what exact price you're going to enter the market. So I've given all of this information to you in those handouts. The Fibonacci retracement guy will go over everything we talked about in class, give you lots of examples, lots of charts, lots of information. Then the introduction to technical analysis will explain all about the other types of analysis you might want to use, how to put a support and resistance lines on your chart, what a trend line is, what other tools you might want to combine with Fibonacci, where you should put your stop losses and take profits. And then our technical indicators guide will go over the primary, most popular used technical tools that you can combine with Fibonacci. And then on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. Thank you for supporting Legacy FX as well as investing.com. And if you want, go to Legacy FX. That's www.legacyfx.com and open a demo account. Use their education, use their charts, and use the demo account to see if you can put your Fibonacci tools on there and see how you could use it to incorporate in your trading. So have a great night now, and thank you for being part of the investing.com family. Good night now.